well as a solution as well. So thank you for joining us today. Just obviously we'll talk about some of the economic data points that we're all kind of living amongst. We'll take a quick look at the QCBI results. David will touch on credit, and then again we'll just share with some updates what's new here at Quick Analytics and IntelliCredit. So again, just a few slides, right? I think the environment we currently find ourselves in, right, just is constantly evolving. I think, again, we touched on this last quarter, just the amount of information available and the conflicting and sometimes, mixed signals. You can build an argument for really anything, almost any case you want. There's enough data there. And I think it, again, leaves the Fed in a very difficult, task. We certainly said last quarter, there was a dilemma that the Fed had, which was to, either act aggressively to regain credibility, as it regards to inflation, or they could go slow and play catch up. So they clearly have, acted aggressively. The rise in Fed funds rates and the interest rates has certainly been something to behold from where we were, just a year ago. And they, that playbook is, clearly is going to remain the same. They're going to continue to raise the Fed funds rate until they feel like they've got inflation under control. And they're going to eventually reduce the size of the balance sheet. I'm not sure how much of that's really taken place yet. But they're clearly running the same playbook where they have, made it a point to continually raise rates here until inflation begins to moderate and subside. So, I think what we think, and I think the data certainly suggests is that rates are going to remain elevated through 2023. But again, back to those mixed signals. In spite of all that, to this point, labor demand has continued to remain strong. Month after month, the economy continues to produce new jobs. The Fed is going to continue to tighten policy. The central banks around the world are being more restrictive, but the dollar continues to be strong and continues to rise. And again, we've still seen, global inflation pressures. Now, we did finally see the growth rate slow a bit last month. So, that's probably the first step in trying to see, consecutive months of it either slowing or actually starting to roll over. So that remains something to watch. Just some thoughts we've had on the third quarter bank performance results, right? Again, I think the question everybody continues to grapple with, are we headed for a soft landing or a steep recession? I think, or maybe I should have a third option here. Maybe it's a shallow recession that we end up entering into. But as each month passes by, the Fed does buy themselves some time and gives themselves a better chance of a better outcome. Again, as the economy remains strong and not being abruptly halted by the interest rates, it has fared pretty well with it. Certainly for now, there are no hints of a recession in the bank performance that we'll see. Core profitability continues to increase. The interest rate increases so far have been, more easily incorporated into the loan books and securities portfolios than they have been seen in the deposit costs. NIM, grew for most banks. Now the deposit costs did increase and certainly will probably continue to do so. But I think banks have done a great job of getting ahead of that with their loan books, but also they, I think had a fair amount of cash that they've been able to redeploy at obviously much higher and more attractive security rates. Reserves, for future losses still remain strong. And I think, a lot of this, the underwater securities portfolio, just all the uncertainty has certainly slowed M&A activity in the last quarter. I think we'll continue to need to monitor these rising interest rates because they do have the tendency to expose problems in financial markets. They certainly could cause us next year to see banks taking losses on mortgages and some of these potentially underwater securities. Certainly, if a bank or any of the lenders haven't made adequate provisions, then then again you could start to see more signs of stress. And, you know, we know the Fed's going to continue to raise rates. So we just need to remain vigilant, as David has said often on these presentations around credit quality, and now increasingly liquidity and interest rate risk. The yield curve inversion certainly suggests that, you know, investors are more pessimistic about the future growth prospects. They certainly have been precursors for recessions. And again, we've talked about it, and David, I'm sure will touch on it, right? While the current credit quality metrics remain really strong, it's not unreasonable to think that we may start to normalize there here over the next year. All right. I think, you know, what we're seeing, I know at our bank and our small community bank, we've certainly seen in the last, couple of months, an increase. I'm not sure if you call it interest or just inquiries, certainly from our customers about receiving, increased deposit pricing. I think it's certainly becoming more widespread and apparent that, our customers are shopping, rates. They're being inundated with opportunities from a number of sources. So I think that will remain a challenge for us. I think for the banks that have underwater securities portfolios, that number certainly grew in the third quarter. And then again, next year, we'll see an increase to the deposit insurance fund. So, again, while everything is really good right now, there are, continue to be headwinds that we'll have to deal with, going into next year. Certainly as, banks that are beginning to deal with tightening liquidity, I think certainly monitoring your large borrowers, evaluating your loan offering rates, evaluating maybe securities to sell for liquidity, utilizing wholesale funding, maybe creating new deposit types. All these things are things that are probably on your radar and to be considering, as we move forward, into the fourth quarter and to next year. I did want to just make a note about those unrealized losses that, many banks are experiencing. Again, for most banks, since it's not a regulatory concern, it hasn't posed too much trouble yet. It will potentially start to maybe impact some banks with their FHLB advances. But you can see just from 6/30 to 9/30, the number of banks whose tangible capital or common equity, is less than zero, rose from 11 to 31 banks, but you can just see anywhere from 0 to 5%, the numbers kind of across the board continued to increase. So, this is, again, something to monitor, something to be aware of. Certainly, since all the home loan banks, operate independently, I think it's important if you are in a situation where your capital numbers might be going lower, just make sure you understand the rules around renewing advances and whether you can take down additional advances, because while most of the banks trim the same way as they are a little bit, they all have their own rules. So it's important to make sure you understand those as we go forward. So just looking at the 9/30 numbers, again, we are decidedly under now 5,000 banks in the country. You can see again the breakdown. 83% of the banks are still under $1 billion, but increasingly the amount of assets, goes down. So we're at about 34% of the overall banking assets. Asset growth over the last 12 months, and again, these are last 12 months numbers, has come down. But, again, not maybe as much as you'd see, but the largest growth obviously occurring in the $1 to $10 billion banks. This, I got to say, David and I were talking about this a little bit before the presentation today. This number, surprised me. Again, if you start to think about, numbers in a number of different ways, last year, maybe 12 or 15 months ago, we were talking about, states that were having negative loan growth. And now here over the last 12 months, the industry has seen a pretty good rise in loan growth. Again, on the one hand, that can be seen as a positive. On the other hand, it might be, if you do believe we're heading towards recession, it may be interesting that we're lending, these kind of lending numbers are occurring if that is the route we are headed. So again, I think depending on how you view these numbers, again, the glass might be half full where you think, hey, we're going to engineer that soft landing. We're going to be okay. The flip side is if we do have a recession, some of these loans might be the ones that, potentially begin to cause some stress. Deposit growth, again, had been incredibly strong, but even in the last 12 months remained pretty strong, particularly when you look back versus what we were pre-pandemic. Most banks, 80+% of the banks did still continue to see deposit growth, and it was actually realized by banks of all sizes. So, that's encouraging. Again, I think we have seen, here at Quick Rate, certainly an increase in banks issuing. I do think the underwater securities portfolios are having some impact. I think the idea of trying to get out in front of rate increases has had some impact. And then I think the availability of maybe potential future home loan bank advances has contributed to that. And the final one is then just not cannibalizing your local market. So for a lot of the same reasons that people have accessed Quick Rate in the past, I think over the last, certainly the 9 months and the last 12 months, we really seen a return of banks to the marketplace. Some performance numbers, as we touched on, right, are all really, really good. I mean, yield on loans has come down. Cost of funds has gone up, but the NIM, for the first time in a couple of years now we've got an increase over the last 12 months, which is nice to see. Non-interest income, remains lower, obviously, largely attributable for many banks just to the lack of mortgage income there, and the efficiency ratio improved. So again, from a performance standpoint, everything looks really, really good. And that is even more evident in the ROA numbers, right? So median pre-tax ROA, you can see over the last 12 months up. To the far right here, you can see across almost all of our asset buckets, 1% or higher at the median. Again, far cry from where some of these smaller banks were seeing numbers last year or beyond 12 months ago. So really an encouraging story there. Core operating earnings the same way, an increase over the last 12 months to median numbers we haven't seen in over 5 years. So the bank performance is just, again, really, really, really good. Median ROA, again, you can see, and then the equity numbers, return on average equity, other than the 0 to $100 million banks, right, all double digits over the last 12 months. So just a really good story. You can see here over 54% of the banks have above 12% return on average equity. So, again, really, really just really strong numbers as we close out the third quarter. So at this point, I will turn it over to David to take the second part of the presentation. David, the screen should be yours.
Okay, Sean. Well, I always, hopefully you can see my screen. Yep. Always enjoy the quarterly updates with you to our broad audience. So thank you all for being with us today. As I typically will do, we'll touch on some national and regional credit metrics. Again, they haven't turned. They continue to be stellar and benign, as they say. Of course, these numbers tend to be a little bit trailing or are trailing in terms of any kind of credit degradation that is to come. First, let's look at the primary metrics in quality, loan quality. NPLs continue to go down. This was something, again, spring of 2020, no one would have ever thought this would have been even possible. We know, of course, the government intervention and largesse had a lot to do with that. One region has, the Northeast has ticked up a bit in NPLs. Net charge-offs continue to be almost negligible. Some states and regions are still in actually net recovery due to a lot of the problems, particularly in the Southeast, still with real estate. There's still some recovery going on there. As you can see, the ALLL to loans, which is the more conventional way we look at our reserves to our loan portfolio, has somewhat begun to dip down a bit. I would argue that if we did the thorough math on that, it's really because of the loan growth that Sean alluded to a moment ago, that really the reserves just haven't kept up with the loan growth. that we've experienced. Somewhat the inverse of that is of course, how much of your problem loans or NPLs, non-performing loans, are covered by current reserves. Of course, that has nothing to do with capital cushion. It's strictly just reserves. The only real news there, it seems to me, is that the Western states have traditionally, for the last several years, kept a higher degree of coverage than the other regions. In this particular case, the Southwest, it appears, has kind of bolted ahead. Although I was in California last week, for instance, speaking at a conference, and I know they're averaging as much as 500% of their acknowledged problems in California is already covered by reserves. So again, the industry appears at this point certainly to be adequately reserved. Other concentrations, particularly that we focus on traditionally, of course, is real estate. And you look to the left, which is the subset of the broader 300%, the subset, the 100% guidance, construction and development loans, you would expect that those numbers would always kind of parallel regions of the country that are experiencing demographic growth and some economic growth. And that is clearly the case with the Southwest and the Southeast leading those. As you can see, there are 266 banks nationally that exceed the 100% guidance. It is a guidance, not a regulation. The broader measure, which is the CRE to risk-based capital to the right, which is the 300% guidance. Again, traditionally, the West has been ahead of that, and behind that is the Northeast, largely coastal areas that have led that. 328 banks exceed that. In some of the other concentrations that we follow, the multifamily, again, both the Northeast and the West lead in that area. The C&I chart I've been dismissing for the last 2 or 3 years on this broadcast because it was really PPP related, the big blip in the middle of the chart. But one of the things that Sean and I were talking about just earlier before this presentation was these numbers could also imply that the community bank, because as you know, the metrics we use at Quick Rate, Quick Analytics, and IntelliCredit is driven by 10 billion and under size institutions or banks, is that frankly, community banks have kind of returned. In other words, didn't really capitalize on all this PPP. So much of it was C&I lending. Has really returned back to a little bit above the norm. So for all the people that were hoping that the community banks could capitalize on all that exposure with PPP exposure, some of that is perhaps kind of gone away again. We kind of reverted back to what our comfort zone tends to be in our community bank industry, which is, of course, CRE lending. Not surprisingly, the Midwest leads these are commercial bank numbers. They don't include farm credit numbers, concentrations nationally in ag and farm. Again, we can't say it enough. This is a stellar performance in terms of loan growth. Some of you have heard me say in previous quarters, I know about a year ago now, we were really wringing our hands that organic loan growth was extremely tepid in our industry. If you take away the PPP activity, you really had very, very tepid loan growth, which was not going to be sustainable from a profitability or evaluation standpoint. We certainly understand that. So significant loan growth has occurred particularly in the last quarter or a couple of quarters. I still acknowledge that this is a headwind we as an industry face, and that is arguably now 50% plus of commercial purpose lending is now provided by bank or entities other than commercial banks, which is again part of the headwinds we operate in terms of the broader economy and lending. So credit quality metrics again remain at generationally high levels. However, I think I've been in 21 states since June 1 and speaking at conferences. I think there's unquestionable consensus building in the industry that we just can't have this level of inflation and rate increase velocity without avoiding some future credit stress. It's just really would be defying the law of physics almost if that didn't occur. I use this chart, it's a little more than academic to me because I've actually been in the industry almost 50 years myself, just to depict the fact that much of the credit stress comes after various and sundry financial, economic, and geopolitical shocks. If you look at the 2020s, we are still young in this decade, arguably, and we've already had our quota, arguably, of significant shocks, from the pandemic to all the government largesse that probably had tremendous amount of impetus to spur on the inflation. And then we've got these significant historic rate increases and so forth. All to say is that credit stress always is preceded by these types of actions and activities, which again, we've had our quota already in this arguably young decade. So again, it would be very difficult to think we wouldn't have at least some degree of credit stress in the next 2 or 3 years. So what are some of the causes? Obviously, the record-setting inflation, rate increases, been spoken about a number of times, even on this presentation. One of the kind of inside issues that we're dealing with in the industry that's really coming up in our loan review work and our due diligence work is that post-booking credit servicing is struggling throughout the industry. Now, some of that is a result of personnel. It's the result of being able to recruit and retain talent for kind of back shop analysis work, basic risk management. Some of it is the industry and borrowers are still shaking off the lethargy of providing banks with current financial information after the problems that occurred during the pandemic. But the truth is that this is beginning to show its sign significantly in our loan review work, that servicing is suffering. People are falling behind on annual reviews. And we know that this would be an area that regulators are going to focus on. And unfortunately, regulators, as you know, are agnostic to the size of the bank when they expect and consider these are certain basic protocols on risk management, such as annual reviews and understanding, getting current information from borrowers. Again, while the post-PPP organic loan growth is clearly impressive, as Sean and I both alluded to, it does conjure up the lesson we learned in the last financial crisis, and that was the potential for having a bit of a sour vintage. In other words, loans made late in a benign credit cycle tend to always be the most toxic once a credit environment seems to have turned. It always has proven to be that. Reserves are firming, as the data would indicate, but again, as I said earlier, it's not at the pace of the current loan growth. One of the, we're not heavily involved, as Sean said, in a lot of M&A activity, but we're in the middle of one as we speak. And the interesting dynamic here is that there's really more focus, not surprisingly, on the yield marks of the portfolio of the target bank than it is on the credit mark of the portfolio, because at this point still there's virtually little loss or even delinquency emerging at this particular circumstance. CRE, as I said earlier, it appears that community banks have gone back to their kind of comfort zone around lending at CRE and even perhaps doubling down on it. From what numbers I can see of late is that we're setting record levels of CRE exposure at the community bank level. And I know that's been our kind of bread and butter for almost arguably 20 or 30 years now. But I will say that I'm hearing a specialist talk in some of these conferences I've been attending and speaking at, and particularly looking at certain subsets of CRE. For example, it was a consensus last week in California, one of the conferences I spoke to, where office and hospitality were considered kind of red flags. Office, for obvious reasons, we've talked a lot about that in terms of the paradigm shift of working in an office. But hospitality, I thought one of the interesting points made was that there is some fear that the working or the business traveler is not and maybe will not return to the levels of pre-pandemic. And that is a huge area of dependence by the hospitality industry in terms of business travel. The advent of Zoom and virtual meetings and training even through virtual processes has perhaps tamped down a lot of the business travel that really fuels hospitality profits. I know small business and consumer lending is a key concern. It is universally considered by even the FDIC to be the two areas that they are the most concerned about in terms of credit quality. But on top of that, you've got the CFPB and the Dodd-Frank Section 1071 implementation looming on collecting. It's almost like a HMDA type data collection on all loans that are made for business and consumer lending. So, that is out for a rulemaking commentary at this point, but it does appear that some form of that will be affected and enforced starting next year. I think the quality of loan review is probably as important as it's been in a number of years. And we feel very strongly about that, of course, at IntelliCredit. I do have my biggest concern, as I've shared with people for over a year now, is that there would be some overreaction by regulators and investors. And I think it just puts the onus on all banks, particularly in the next couple of years, to kind of write your own script. Remember, you're the one that has access to your own idiosyncratic loan data. Only you have that. Even regulators, unless they're in the throes of an examination of your bank, are looking at you largely through public or call report data. Often there's a lot of a story to be told in your non-public data. And I think you're going to have to depend on that kind of tactic, frankly, to perhaps disabuse a regulator or even an investor in seeing some data that gives them alarm. You've heard us talk about this. These are kind of our strategic goals at IntelliCredit, to do all we can to more closely sync three very critical inputs to credit risk management: stress testing, portfolio analytics, and loan review. That's really the cardinal strategy of IntelliCredit, is to try to put those three heretofore usually divergent inputs in a much more synced and complementary fashion to bank clients. I do think in terms of more granular portfolio analytic recon, it's going to be necessary from a defensive standpoint in the next couple of years, as there's likely going to be some kind of uptick in credit stress. Looking for hot spots, being able to drill down to the suspected borrowers. Don't wait for call report data to show you where you may have some concerns. Early detection of credit risk is obviously a critical strategy to employ. Stress testing is being mentioned more and more and more all the time. We are working on even more enhanced loan level stress testing at IntelliCredit to complement the portfolio level stress testing that is in place over at Quick Analytics. And we're also, as we speak, are doing loan review stress testing companion with loan reviews, which is providing, I think, a way to take a subset of the loan review sample and stress it concurrent to the loan review itself, which is proving to be, I think, very effective for community or less complex banks. And I mentioned enhanced quality loan review. We're just huge believers that in the next 2 or 3 years, you're going to need skilled reviewers, people that are steeped in experience and credit, to be able to use their powers of persuasion. After all, you do want, while everyone wants a pristine report and a rubber stamp, so to speak, the truth be known is you'd rather have loan review identify earlier than a regulator any kind of emerging credit problems. I think that just makes common sense. So dusting off kind of your understanding, we recommend you getting bios of anybody that's doing loan review to make sure they're not just skilled at the quantitative art of credit, but understand the qualitative as well, which is usually more judgment-based and experience-based. And then, of course, CECL, of course, finally getting to the point of being expected to be finalized into the first quarter of next year. And I do add this: remember, for all the things that people didn't want to have to deal with CECL, it did add some Q&E factors. Remember, it's still the predominant factor in CECL is your Q&E. We used to call it the unallocated a decade or two ago. But the existing Q&E factors were added. There were 4 added under the CECL guidance, which gives you the ability to begin at least to try to quantify or identify any of these 4 added Q&E factors to affect your reserves. So with that, again, we appreciate all the opportunity to revisit with you all quarterly, and please call us on any credit areas that you may need some assistance on, or we'd love to, give you a bid on loan review for next year. No question about that. So Sean, I will stop sharing and hand it back to you.
Okay, thank you, David. All right, let me get my screen back up here. Bear with me 1 second.
There we go.
There we go. All right. Okay, so just a couple of reminders, as David said. I think if just to echo what he closed with there, IntelliCredit was started here with David and his team joining us in midway through the summer of 2019. We really started at ground zero there. We had an idea and we had a vision, through David and his team, and we've built, I think, now an exciting platform. Again, there's a number of ways that you can work with us in IntelliCredit, but I think it's really an exciting new tool. So I'd encourage you, if one, as David said, right, if we can have the opportunity to bid on a future loan review, we'd welcome it. Secondly, the analytical tools that are available to you now to not only conduct annual reviews, but internal loan reviews and analyze your own portfolio, I think, have come a long way, and we'd certainly welcome the opportunity to show it to you. For those of you, again, unfamiliar with Quick Analytics, we aggregate that call report information to allow you to see not only your information, but that of every other bank in the country. We have, we think, obviously, appropriate regulatory tools when the situation arises, such as the portfolio level credit stress test, as well as a CECL solver, which has, been tremendously popular this year. So if you haven't begun that process yet, we can, turn you around pretty quickly if you're still evaluating providers. As I mentioned, Quick Analytics, we're really kind of founded on the 3 concepts of bank and peer performance, interactive bank pages on you and every other bank in the country, and then those regulatory tools such as CECL and the stress test. So the question is, does IntelliCredit offer a tool to help with impaired loan analysis? So we do through our loan review. Is actually a question we kicked around today, and so we are going to try to take the tool that David and his team uses during loan reviews and build a tool that hopefully then we can deploy into Quick Analytics. David, anything you want to add there?
No, we certainly are deep veterans. Remember, we have experienced much of the financial crisis of 12 years ago, and of course impairments were the name of the game in those days. So absolutely, we do impairment analysis. We understand the changes under the CECL in terms of what it technically requires, but in effect, you're still going to need to identify a credit that is clearly not performing of any significance or any materiality. But absolutely, we use impairment methodology all day long during our loan review.
So yeah, so we can follow up with you and see if there's something we can do in advance of that tool being built. Again, if you have any questions, I don't think the chat is enabled today, but the Q&A button still certainly works. It said, I saw officers and directors listed on the earlier screen of resources. Where is that located? So it should on the bank holding company pages, we are, have some of that information listed. We're increasingly working on, improving the way that's reported, but it's really more focused on the public companies right now, but you can see that. And then we're working to get all those Y6s for all the banks listed as well. So it's probably a little bit incomplete because, again, it's focused right now just on the publicly traded banks, where that information is a little bit more easily available from the holding companies and from the Fed offices. As we mentioned, loan review services, again, David and his team can handle third-party external loan reviews, but then you can utilize the same tools that they use for the loan review internally through our smart loan review service and the portfolio analyzer. And again, we've developed an annual review functionality. So built upon the flat file, we're really excited about the progress that we've made with developing some of these new applications.
Sean, I'd like to just interject there, if I may,
Yeah,
is that
sure.
the strategic goal we set in 2019 to make loan review more efficient and less intrusive. I feel like we're getting a lot of plaudits in that regard, but also having loan review sit on the same platform as an analytic tool is making it also what we wanted to do and make loan review less of a point in time static, if you will, stale event that becomes more organic, more living and breathing within the analytic tool of the broader portfolio itself. So for all those reasons, we think that while we pride ourselves on having deep talent to do the review work, it really is facilitating a lot of technology to make it more efficient, more less intrusive, and more informative.
Thank you, David. Yeah, and I think that's a great point. So again, encourage you to reach out if you want to see a demo of any of those new solutions. So, we understand all of you are busy, so we appreciate your time today. We've tried to develop tools to improve your efficiencies, take some of the things you're doing today and try to make them easier for you. I think we've done that with CECL. I think if you give us the chance, we can show you that with loan review as well, and certainly would welcome the opportunity to quote a future loan review. But if nothing else, to at least demonstrate our new tools to you, and you can decide if those could benefit your team in your bank, right? A lot of times we hear when we talk to banks about their internal review process, it's typically involving cobbling together Excel spreadsheets and Word documents. And I think what you'll see with the application we've built, we put kind of all those things to rest, because everything will be resident in the application. So it just saves your team time in aggregating data. Much like in quick analytics, I think one of the immediate values we always bring is that the time we can save you in aggregating data. I think in terms of loan review, both external and internal, we do the same thing for you, because once we have that flat file of yours, we can just make it available to you in a number of different ways, which just it speeds along the process both externally and internally. All right, just a couple of reminders. We have some webinars upcoming. We have a CECL Coffee Talk this Friday. We'll have Jeff Fair. Jeff's a bank consultant who we've worked with for a number of years. He's going to join us and share his insights on CECL. We do have just an overall CECL demo in December as well. We are going to have a liquidity webinar next Tuesday that you can certainly register for. And then I'd encourage you, I don't know if we have it up here yet, no, but David will be having a loan review and just a kind of an IntelliCredit focused webinar coming up in December as well. So certainly check the webinar on Quick Rate for upcoming future presentations. So on behalf of David, again, I want to thank you all very much for your time. We really appreciate each quarter you taking time to come and attend these webinars. If you have any questions that you think of afterwards, certainly reach out to us at info@quickrate.com or give us a call, or just email David or myself. And we'll look forward to talking to you again next quarter, and then potentially even in the interim with the coffee talks and liquidity webinars next week, and the loan review one in December. So thanks again. Have a great day, and we'll talk to you soon. Thank you.